What's going on, traders? Welcome back to another video. Thank you guys once again for tuning in. Today, we're going to be taking a look into the basics of the options chain on TD Ameritrade. Many of you guys have asked me to do some videos on options, so now I'm finally getting around to doing it. So tonight, I want to walk you guys through just the basics of the actual options chain to help you guys understand what it is you're exactly looking at when you get into the options chain. So many of you guys are going to be familiar with Thinkorswim's platform or TD Ameritrade's trading software. Generally speaking, most of you guys know what this screen looks like. This is your chart. Now, to get into the options chain, you're actually going to want to go to the Trade tab right here. Once you click and enter the Trade tab, it might look something like this. First, you need to enter a ticker in the search bar here. So we're going to look at the S&P 500 ETF SPY. So we'll type this in. And let me close up a little bit of this, okay? So generally, this is what it's going to look like, and I'm going to close out a few of these chains. So everything that you see here is just the option chain, and it actually says it right there, option chain. And all this stuff located below that I'm putting inside the box, you will see has a bunch of dates, all right? So you see here, May 20th, May 22nd. So what you're seeing here is the day of the month, and the year. So if we go all the way down, you'll see 19 will turn to 20, and all the way to 21. I might have covered up those, covered up some of those numbers, but that's okay. So again, in this box, all this is dates, okay? And each one of these is an option chain. Each one of these little boxes that I'm putting an arrow in, these little categories. These are option chains. So here we have May 17th, May 20th. Okay, we have June 17th of 2019. All the way down here, we have 19th of June, 2020. Okay, 15th of January, 2021. All right. So as we open one of these up, okay, this is what you're going to be looking at. So from here, you might get a little scared, a little bit confused, going, what am I looking at? This is a lot going on, especially when the trading day is open and the market's moving. These numbers are all going to be flashing, right? I mean, every single one of these are going to be flashing green, flashing red, changing. These numbers over here are changing. This is changing. That's changing. This is changing. Things are going this way. Things are going that. I mean, there's a lot going on when you look at one of these option chains, especially during the trading hours or active trading hours, because there's a lot of numbers all kind of flashing around in green and red. So at first it can be a little bit intimidating without a doubt, okay? So what we're looking at here is the option chain on the S&P 500, all right? So I'm going to pull up a chart here as well, okay? What we're looking at here is the S&P 500, and let me just kind of zoom in on today. All right, and we'll go back and take a look at the option chain here in a second. But this is the S&P 500, okay? It costs quite a bit of money, right? It's priced at about $286. So if I wanted to go and buy one share of the market here, this S&P ETF, I'd have to spend $286. That's quite expensive, all right? So that's why a lot of people will trade options, because options can tend to be far cheaper. Whereas right here, okay, on this chain, let me go into the one that expires here pretty soon. These expired today, so we'll go to this one here. We'll open this back up, okay? So for example, I could buy one contract for $74. So I could play the market with $74 rather than spending $286, okay? So for one, that's kind of why people get into options, but let's keep it basic here with the option chain. So this is the option chain, and from here, you could buy this, you could buy this, you could buy these, you could buy these, whatever you want, okay? So on this side, this is bullish, okay? This is bulls. And on this side, this is going to be bearish. These are the bears, okay? So if you purchase anything on this side, you're hoping that the market goes higher, or you're hoping that the S&P 500 ETF goes higher. And if you purchase over here, you're bearish and you're hoping the S&P goes down. All right. So again, left side is bullish, right side is bearish. What you see here in the purple, this is called ITM. Over here, this is called ITM. Purple or blue, whatever it is on your platform, is called in the money. The black is called OTM and OTM, out of the money. We're not going to get into exactly what in the money and out of the money mean in this video, but just so you know, purple's in the money and black is out of the money. All right. And generally speaking, the goal of any option trade, in simple terms, is to be in the money and not out of the money. Again, I'll rephrase that. Anytime you're really buying an option or trading an option, for the most part, your goal is to end in the purple. If you're bullish, you want to be in the purple. If you're bearish, you want to be in the purple. That is generally speaking the main goal. Okay, and there's more that goes into it. All right. What you have here is strike price. Everything you see right here, this is the price or a strike price. All right. And then there's something right here, which is right in the middle of OTM. Or sorry, excuse me, that's backwards. Right here is ITM again, purple in the money. And black is OTM out of the money. And then we classify this middle point between the two as at the money, where you're basically in the money, but you're not. You're kind of hovering right in the middle. We call that at the money. What you'll notice is at the money, if you go over and look at the price, it's priced at about 286, 287. Now, if I bring you up a chart of the S&P 500, you're going to see that the price is what? About 286. Okay. So now we go back to the option chain. Remember that an at the money right here, right in the middle, means you're basically buying or located right at where the actual price of the underlying security, stock, ETF, whatever it may be, is right there, right? 286, 286, 286, 286, all right? So just understand that this midpoint, this kind of middle of the road level, is basically where the stock is trading at, right? So if you went and looked at Netflix, right, and you're right here, and it shows strike of 300 or 350, you go look at the stock price of Netflix, it's going to show 350, okay? So these are strike prices, and these are prices that you pick, okay, when buying an option, okay? So if I come into here and I want to buy this 287 strike, right, I click buy. So you'd actually click right here. You click to buy, and then you can change this to 1, or you could change this to 5, however many you want to purchase, okay? So that's actually, you would go in and buy. Now, we're not going to go into exactly what strikes you would pick and why you'd pick them in this particular video, but just want to kind of identify that a strike price, to kind of give you a general idea of it, a strike price in terms of trading an option is generally a price point on the chart, okay? So again, we're at 286. If we wanted to get long on the market here with the SPY, right? And if we buy a strike of 287, right? So we buy this one, so we're going to purchase this call. Its strike price is 287. Generally speaking, we would be buying this 287 strike price not because we want the stock to be at 287 or we want the market to be at 287. It's because generally we feel or we expect or anticipate that the market is going to press or go above 287, okay? We are hoping and looking for the market to increase in value over the price of 287, okay? Another thing about strike is the strike price is where you set it in stone, okay? Remember that when you trade options, they're classified as an option contract. And the strike price is what you set in stone when you buy the option. I am buying the 287 strike price option, okay? We can go into more detail, but that would take us down a rabbit hole. We don't need to quite get there just yet, okay? To touch a little bit deeper here, up here, you'll have different categories that you can put on. Volume and open interest, okay? Different things like price changes, last price, net change, okay? Intrinsic value, extrinsic value. Delta, gamma, theta, vega. These are the Greeks. Delta, gamma, theta, and vega are going to probably be one of the most important things you guys will have to learn about options. But this is generally the option chain. You can see a little bit more information up here, which is pretty self-explanatory. Volume, the open of the market, high of the market, bid, the ask. So those are pretty generic, pretty simple things, okay? What you'll have to take time learning is the delta, gamma, theta, vega, which we'll probably touch on in later videos. But up here is just a category in which you can basically pull up whatever it is you want to know about the option you're getting ready to purchase. Over here where it says spread and how it says single, that means I'm just purchasing one, right? I'm just kind of purchasing one leg. We're starting to get a little deep. I won't go too much further. But if you're a little bit more advanced in options, this is where you would actually start to open up different option strategies, like a straddle, a strangle, butterfly, condor, iron condor. All right, this is definitely getting a little bit more advanced. For most of you guys just learning out, you probably aren't going to touch very much on these, and you're not going to really mess around with that. So you're probably just going to keep that single for now, okay? But generally speaking, that is the whole option chain. Everything you see here are different options you can purchase. That's how it is, options. And each one of these little options that you can purchase are just different options. They're giving you options to purchase on the SPY, okay? So again, most important thing out of this all that you have to remember is purple is what we call in the money. Black we call out of the money. This midway point is called ATM, at the money. Here in the middle are your expiration dates. Here on the side are your strike prices. Basically a price that you're picking in which you think the stock is either going to go up further than or below than if you're short. Okay, if you're short, you want it below then. If you're long bias, you want it to be above that strike price you pick. Now, in later videos, we'll touch on more detail about this, but this is a quick video I wanted to release to you guys, kind of give you guys some insight to the actual options chain. If you guys have questions, feel free to post them in the comment section below. I'd love to hear what you guys have to say. And let me know if this was clear, concise, and you guys actually understood what it is that I was bringing to you guys. And if you're a little bit confused, again, just know that we will do some more videos on options and different things about them that will probably clear some of that up for you guys if you do have questions. So again, feel free to let me know what you think in the comment section below. Give it a thumbs up, like the video, share it if you need be, and I will see you guys on the next video. Take care.